G'day expats, welcome to another episode of Expat Chat, episode 67 today, and as always joined with my co-host, friend, colleague, business partner and mentor of course, Brett Evans. G'day Brett, how you going mate?
Mate, all good here. It's starting to get foggy again, which means we're breaking the season and winter's in sight. So looking forward to that greatly. Those people who live in the Middle East know it's quite a pivotal time. Your lifestyle suddenly becomes a lot more active and outdoors and yeah, you don't have to think as much. You don't have to sit there and go, can I take the dog for a walk? Is it too hot for
Yeah,
his feet? So
yeah.
all those things. But for the folks out there who are new to the channel, g'day. And just let you know, joined by my colleague and mate and Master of Australia and the APAC region, Mr. James Ridley.
Beautiful, what an introduction. Mate, you're on the other side. You're obviously, it's getting cooler on this side. It's starting to get hotter, but we're blessed with La Nina conditions at the moment where every week is just wet and Victoria's going through its flooding at the moment. We just
And an
can't seem
earthquake, I
to.
believe. I had an earthquake
Yeah,
today.
yeah. It's that. Well, I mean, that's I had one of those a little while ago actually.
Yeah,
But it's pretty strange when you hear of any earthquake actually happening in
in
Australia, to be
Australia.
honest.
Yeah.
Um, so yeah. I guess not sure what to make of it. I think everyone's more concerned about how we're more in a wet season at the moment, heading into summer.
Yeah.
Um, definitely been a testing year, that's for sure. But I mean, new year coming up, and gosh, this year has gone quickly. I can't believe we're almost at the end of October. It's remarkable.
No, the usually the alert for me or the milestone for me is when the kids start to get fired up about Halloween, which is just a bit over a week's time.
Yeah,
And then
yeah.
once that's done, it's full steam ahead into Christmas.
Oh, there's talk in my household of putting up the Christmas tree soon. I'm going, you got to be joking.
Oh, yeah.
Put it down. Come on, that's too early.
Our house is a bunch of purists. So it's always the 1st of December it goes up and the 31st it comes down.
Yeah, well, it's funny. You go to Kmart, Big W, those sort of
They're all there.
local, all the Christmas decorations, all that sort of get up is around. So it's definitely heading for that season very quickly. But I mean, mate, we're always digressing. We can talk for
We
hours. Let's
love
be
to.
honest. I want
Yeah,
um, good conversation today. Good chat in terms of topic, and want to look at superannuation from a high level perspective and go through sort of different types, contributions. We received a good question, which and some feedback actually, which a common theme was around super contributions, options. Can you do it? What can you do when you're overseas? Those sort of things. So I thought we'd just cover it from a high level perspective and then sort of deep dive and workshop a few other categories as well. But before we jump into it, as always, bit of a legal disclaimer.
exactly. All the information that we are about to espouse to you fine folks should be considered as educational and informational purposes only. Please do not construe this as personal advice. If you do need to get personal advice, have a chat to us.
Sounds good, mate. Now let's deep dive. So superannuation, as we know, it's essentially our main or potentially main retirement asset back in Australia, depending on who you speak with and what you're doing. But superannuation been around for years, and there's obviously a few layers when you deep dive into superannuation. But obviously, if we take a step back and zoom out, superannuation is that retirement account when you are employed in Australia. You'll receive right now your mandated 10.5% as a minimum super guarantee from your previous Australian employers. That'll kick into some sort of default super fund, likely one you probably haven't chosen. It's just sort of been set up through the employer. Depending on sort of the type of work you do, you might have a military super, account where it's got its own internal rules. You might have a government super like PSS. You might be part of the CSS system. You might be CBUS. You might be HESTA. The list goes on when you look at all the different types of superannuations or superannuation accounts. But that's how we obviously have some sort of super. It's from an Australian employer. We usually might not have kicked into it until it becomes a bit more serious, especially in the later years. But that's sort of where superannuation comes from. It's a legal requirement by an Australian employer. And some Aussies that are overseas, they're actually still lucky enough to have an employer, an Australian employer, kicking into a super fund. It's not very common these days anymore, but if you've been sort of seconded and you're being what we call tax equalised, you'll still get the benefit usually of super guarantee contributions going into your old Australian super fund, which is terrific. So that's very rare, but you still can see those kind of things play out. But that's, I guess, a bit of an example where superannuation comes from.
And I think it's also important to understand for the folks out there, because pretty much everyone's expats or soon to be expats, superannuation is agnostic to tax residency rules. So whether you're an Australian resident, non-resident, what we call the SIS Act, which is the governing laws that govern superannuation, they don't apply to residency. So whether you're a resident, non-resident, still the same rules apply in terms of taxing rates, contribution amounts, all those sort of things. We've mentioned it many times before, but it's always good to point out contributing to super is not a contributing factor to be deemed as an Australian tax resident. Especially in Asia and in the Middle East, a lot of the offshore IFAs, the used car salesmen who decide to sell, the offshore bonds, they'll use fear and intimidation to convince you not to contribute to super, and say, no, put all your money away, give it to us, and we'll charge you, 100% fees for the next 10 years, and you'll be lucky to get your money back. So yes, you can contribute to super. What it comes down to, that SIS Act rule, is that's the governing rule across all super types: industry funds, retail funds, SMSFs, the whole shebang. Where it gets different is then there's subset rules for SMSFs, which we went through on episode 38 was. So if you want to know about managing an SMSF as an expat, jump onto episode 38 and have a look. We're not going to go into too much detail because that is a topic for itself. But when it comes to all the other types of super, and people might be asking, how do I know if I've got an SMSF, the self-managed super fund? Easy. You'll know. You'll be doing all the trustee work yourself. You'll be doing the tax returns and those sort of things. So if you're not doing that, then you haven't got a self-managed super fund. So let's really focus on the broader the market, which is in industry or retail funds. And keep going.
Yeah, mate, you're right. I mean, and you're about to go into the subcategories where, you've typically got your industry super funds. Everyone's seen those ads when you're back in Australia, where it might be someone holding a little egg, or you've got the hands, or some guys going up in a lift and the other guys going down in a lift. And there's a catchy phrase over it. All industry super funds, they got in trouble because of that kind of marketing. There were some big fines handed out about 2 years ago. So they weren't allowed to do that because it was obviously trying to promote that industry funds are superior when there's actually no evidence backing that at all. So industry super funds, that's sort of one category, and usually they're just a member of a body. So that's why that's called industry super. You've then got what you said before, retail superannuation funds, and that list is quite large and big in terms of all the different super funds.
MLC, BT, IWF, Colonial, Mercer. There's quite a mixed bag there. And what people confuse is the particular provider's rules as opposed to what the governing laws are. So a number of times people approach us and say, oh, my super fund said I can't do this. Well, that's normally because that's your super fund's rules, and it's not actually superannuation rules. And as you pointed out, before, the biggest thing we always find with super is people don't understand they can move. As long as you stay inside the super environment, you can go from one account to the next, like changing bank accounts. You always need to make sure that you know what you're getting yourself in for. The MyGov portal does make it easy to consolidate a number of super fund accounts. But when it comes to the management, and I say this to clients all the time, and sometimes a lot of expats treat super with apathy. They say, oh, I've only got 100 grand there. And I say to them, if you saw $100,000 sitting on the ground, would you pick it up? Like, yeah, of course. Like, well, give a shit about it. Use it, make the most of it. They'll talk about their dwindling balance. It goes backwards and the market's going up. It's like, well, take ownership.
There's
absolutely.
No reason. I agree, mate. Take ownership. Right now, what we see annually now, they name and shame a lot of the industry and retail super funds, which are underperforming. They sort of brought in that rule only, I think, in the last 18 months, to be honest. And it's usually a lot of old retail super funds, which are almost closed super funds. And it's a case where, they're often only got 2 or 3 different investment options. So there's no wonder that they're underperforming because there's just no more money sort of funneling into it. They're not investing more on behalf of their members and all these other things, creating great sort of user experience and investment options. But you're spot on it. Superannuation is technically probably the longest investment that we will have in our lives, yet it unfortunately gets the least amount of attention until we're probably in our 50s, which is just the wrong attitude to have towards it.
And if managed correctly, it should be your largest asset in retirement. That's what people forget. That's what's going to fund. People forget how long retirement is. If you retire at 60 and you live to 90, that's 30 years.
Yeah.
Which is almost the same amount of time as your working career.
That's right.
When you had a job and you had an employer paying your wage. So it's imperative that people do give a shit about super. Certainly when you're in the 20s and 30s, yeah. But as you get into those 40s and 50s, you should have a roadmap, because what people often find is they'll get into the situation where they'll accumulate assets overseas. Okay, I'm retiring back to Australia. I'm just going to dump this into super. You can't do it. There are annual contribution limits. There are, allowances that you can use, bring forward rules and those sort of things. But you're still up against the wall when it comes to how much you can get into super in what particular time. And you need to reverse engineer it backwards. So if you say to yourself, I need to have $2 million in super by the time I'm age 60, look at where you are now, look at the gap, and then work out how much you have to contribute on a monthly or annual basis to get there. And that'll determine whether you're successful or not. We often find that, people, it's sort of almost like a knee-jerk reaction. And, to me, there are a lot of little bits and pieces that, contribute to super in a lot of different ways. And it's that apathy, and that's one of the reasons why we do these podcasts and webinars. We do these things to educate people, to say, this is your money. Take ownership. And it's not hard. Certainly if your super fund is making it hard, move somewhere else. Simple as that.
Yeah, absolutely. I mean, and that's what I think a lot of expats, they have this barrier when they head overseas. Maybe they feel like obviously they can't roll it over somewhere. They think they have to stay landlocked in that super fund or that underperformer, which isn't true at all. I mean, much like sort of the US and a few other countries, your options are almost endless. Probably trying to pick the right one, that's obviously probably the main barrier. And I guess, that's why firms like us exist, providing that kind of advice. But you mentioned before around contribution caps, contribution limits. When we talk about contributions, there's a few different types. There's pre-tax contributions, often coined as concessional. On the way in, they'll get taxed at 15%. Our normal annual cap for those is 27,500. And then you look at non-concessional. Right now, the annual cap is 110,000. Maybe with the budget update in a week, we might get some idea on indexing. That would be good, wouldn't it? Geez, index contribution caps again. That would be lovely.
Well, if you look at Labor's election attempt back in 2019, they tried to reduce it down to 75. So
crazy. Oh gosh.
Whether we see that, just a heads up to folks, and it's a good segue into the link below that we'll provide with respect to the webinars we're coming up, which will be covering off on these. It's Labor's doesn't want you to put too much money into super. They want you to keep money out of super so they can tax it. Because I had a call yesterday with a gentleman, and he's like, so why wouldn't the government want us to have all our money in super? And it's easy, because when you retire, it's all tax-free. No capital gains tax, no income tax. And, depending on which country you move to, if you are retiring overseas, it could be tax-free on both fronts. So super is a very powerful tool with respect to that. And then go.
Yeah, no, or Labor, we love Labor, don't we? God, there was an article recently in the AFR, and you would have seen this, how they're looking at capping balances in super. And it's quite a high balance, so 5 million. And, their argument is, well, if your balance is over 5 million or up to 5 million, it's like clearly you're trying to hide assets because of the concessionally taxed environment. Who needs 5 million to live? That was their argument from who needs 5 million from a retirement income perspective? In 50 years we might, depending on inflation and the cost of living and those sort of things. But Labor have always had an issue with superannuation, the fact that it's concessionally taxed and it's tax-free, and then it's an easy thing to sort of pull the strings behind closed doors on the contribution caps. And it makes me wonder whether they'll take away that catch-up concessional contribution, which is very useful for expats, especially returning. And then even the bring forward rule, it wouldn't surprise me if they start stamping on the bring forward rule and try and introduce, age limits and other things. They've sort of given us one thing with increasing the age in which we can contribute, but they might take away, when we can actually use the bring forward rule as well. But it goes to show that there are many different types of contributions as well. You've got the, concessional, there's the catch-up concessional, then you've got your non-concessional, you've got your bring forward non-concessional, you got your downsizer. And so it's sort of almost endless, the types of different contributions that you can employ as part of a strategy. But depending on your individual situation, that'll govern what's the right thing for you.
Unfortunately, a week doesn't go by that I don't meet someone who they come to you and they pat themselves on the back saying, good news, I'm making ongoing contributions to my super accounts. Fantastic. And then they say, yeah, I do the maximum 27.5 a year, and they don't have a rental property.
Yeah.
So that's when we have to bring the bad news. Well, unfortunately, you're paying 50% tax. Yeah, for
That's
no
right.
reason, because concessional contributions get taxed at 15% on the way in, whereas non-concessional, they don't get taxed at all. So it's always important to go that last mile when it comes to managing a super, making sure that you are maximizing everything, because even when it comes down to the type of fund you're in, they're all different. It is like a car yard, 2 doors, 4 doors, sunroof, yellow, pink, blue. What it comes down to is you can be in a pooled fund, which is what most people are in. So you don't actually own the underlying asset, you own units in a trust, and that trust invests in the underlying investments. How you tell if you're in a pooled fund, look at your statement. If you've got so many units in the balance fund or growth fund, that's a pooled fund. Then the alternative is direct beneficial ownership, where you actually own BHP, Rio Tinto, Telstra, Facebook, the whole shebang. And how you know that is that you look at your statement and I should tell you how many units you hold in those things. And they're all very different things. In a pooled fund, it's sort of almost like the communist way of investing, where everyone shares in the gains and liabilities. Even if you've only been in that fund for the last week, and that fund manager decides to sell BHP that he bought back in 2000 for $10 a share, you will cop that liability, even though you haven't been in that fund since 2000 when they first initially bought that. Also, too, the other issue you got as well is franking credits. So franking credits are the best invention ever for super funds, because you can negate and squash, if not some, if not all of your super liability on the income side of 15% income tax. Because in a pooled fund, the way it works is everyone who's sitting on from cash all the way through to a high growth portfolio the tax rate gets amortized across the whole lot. So in actual fact, instead of paying 15%, that amortization might reduce you down to 12 or 13%. Whereas if you're owning direct beneficial ownership of those holdings, and you don't need to have an SMSF to own direct shares or ETFs. That's the important thing that people do forget. 20 years ago, yes, the only way you could do it was through an SMSF. But these days, retail super has come a long way in terms of flexibility and that sort of ability. And now if, let's say, for example, Telstra pays you a dividend, now that will be taxed at 15% on the way in. However, Telstra also pays fully franked dividends. So you got the 15% income liability, you got a 30% tax credit. So suddenly half of that franking credit extinguishes the income liability. And then when the fund does their annual returns at the end of every year, you'll get a payment back from the ATO of the unused amount.
That's right.
Which then essentially offsets the unfranked dividend in your portfolio. So even in accumulation phase, there's a good chance you shouldn't be paying much tax at all.
No, absolutely not. And I mean, there's even, I suppose, when you look at the different retail super funds, when you look at what you just mentioned there, the pool, the master trust setup, and then you've got the wrap super where you can hold the direct shares, which is terrific. One of the big sort of benefits for even just some of the super funds that we use for our clients is just that accumulation benefit and not having to crystallize capital gains to roll over into pension phase. Unfortunately, that does happen with your typical retail or industry super funds where, you might have been in that super fund for 30 or 25 plus years. You've got the accumulation benefit, which has been funded by your contributions, your employer. There's unrealized capital gains within that pooled investment option that belong to you. And then when you sort of, I suppose, cash out and move to a pension phase, you always notice a discrepancy between your ending balance on the super side, and then your new pension account, because you're retired. And the main difference there, or delta, is just because of the final CGT that you might have had to pay within that super fund. Whereas if you're using maybe a platform super fund or platform super fund, they can in specie and asset transfer, the assets across. So there is no final CGT or tax. It's something which a lot of, I suppose, Australians are fully unaware of, but it can add up a lot when your superannuation balance is getting quite high. Tax can be significant at the end of the day.
They only find out after they've done it. They don't understand the process. And to explain what you're, sort of describing, go back to a pooled fund. You don't own the underlying beneficiary, you own units in that trust. You can't transfer those units across from accumulation account into pension account. So that's why they have to sell you down. So normally there's a bid-ask spread on the unit prices. So they might make it 1% in terms of when they sell you down. Put it into cash, they'll transfer the cash across to the allocated pension account and then rebuild it. So they're copying 1% either side on average. But then also to you're crystallising 20 years worth of capital gains, which are taxed at 10% for assets held longer than 12 months. So as you say, people don't realise it until the money goes into their allocated pension account and they go, wait a minute, why is my balance less than when it left the accumulation account? Whereas by owning Facebook and BHP and Woolworths and all those things, you can actually pick up those holdings and move them across from accumulation account to pension account. And by doing that, you're not crystallizing the game in the accumulation phase. And once it's in pension phase, you can do what you want. You can turn the thing over 3 times and you're not paying any tax.
Absolutely. And I liked your comment before about how I think in the past, self-managed super funds were all the rage because, you could look to invest in direct shares. And nowadays, there's a lot of great super funds which do allow you to invest in direct shares on multiple exchanges. The US market, the Hong Kong market, the UK market, the Australian market. Like your options with some super funds are quite lengthy. Thousands of different direct access to shares, ETFs, managed funds, or the list goes on. To be honest, so yes, I mean self-managed super fund, they're not really probably that common anymore. I often find that people that have set up a super fund in the past, or say an SMSF, a self-managed super fund, they've either been talked into it by an old accountant that's sort of maybe getting something from a developer in the background for selling you an off-the-plan townhouse or duplex, or they like the idea of it initially to set it up and manage their own money, but after 2 or 3 years, they just put it all in the too hard basket. They've got 40 to 50% sitting in cash. They just don't know how to look after it anymore. It's become too much effort. It sounds like a cool idea, but realistically, often there's a high percentage of people that shouldn't have SMSFs. They should just be in retail super funds because the ongoing burdensome of managing it and trying to pick an investment strategy and all those things becomes too much.
And the cost. Your self-managed fund has to be audited every year. You have to lodge tax returns every year. We see costs between $4,000 and $7,000 a year on something that you could actually put into a retail fund, get the same result, and not have that liability.
Absolutely. And that's where people get a bit lazy, I think, with self-managed super funds. And you hear some nightmares where people, because they've got a cash management account, they'll actually dip into their super illegally, and then the ATO is chasing them for a huge amount of fine. So you've really just got to be careful, whether it's the right fit. But these days, you don't need an SMSF to sort of have a similar investment strategy when you want to invest in direct shares.
Yeah, look, I think, that's a good place to leave it because we could go on for a long time. So, thanks very much for Helen in the UK for sending in your question regarding that because, as I said, it's the topic worth dedicating an episode to. The biggest thing we always talk about with a lot of clients is you don't know what you don't know. So hopefully that's, we'll try to distill 20 years of experience into a 20-minute episode, which is pretty hard to do. It's like shoehorning that in there. But at the end of the day, I think people now have an understanding of what they can and can't do, in terms of, you can win lotto and put that money into super. You can, there doesn't have to be a proof of earnings to contribute to super as a non-resident.
No, not at all. Super funds don't ask where it comes from. That's true.
Yeah. So, mate, I think we'll leave the super topic there. Let's quickly jump across to a listener question that came in Just bringing up on the screen here from Graham in Thailand. So Graham goes through and really wants to know more about the bank products that get offered, by Citigroups, HSBC, and these sort of jurisdictions, primarily Asia and Middle East.
Mm.
Are they good investment opportunities? Are they tax advantages? Let's just spend 5 minutes sort of addressing Graham's question there.
Yeah, I mean, of course. I mean, it's a really good question because, I mean, obviously different regions or different countries are in different economic circumstances. You'll find some sort of smaller Asian countries, the interest rates that they're offering in their savings accounts will be a lot higher, might be 8 or 9%, some even higher, to be honest. And then they might have unique investment products, which, are promising a very high income yield of, 12 to 14%. But they are operating in a very different regulatory environment. And I haven't come across too many successful stories on investing in those sort of foreign products, to be honest. They're often layered with a huge amount of fees, and often we get locked up, or when we try and withdraw, it's quite difficult, to be honest. So I would always caution expats to just be mindful of those kind of offshore foreign investments. The yield might be good, but there's obviously a reason why the yields are so high. High risk, absolutely. I suppose the regulatory framework in which that bank operates might be a little bit more flexible and grey compared to, say, back in Australia, ASIC, APRA, the list goes on, ATO. So that's probably my 2 cents on that. Whilst the yield and investment returns might be a lot higher, I think you're also coupled into a much higher risk category.
Yeah, look, I'd agree. And there's a lot of folks who don't have the risk appetite to actually go down this route. And when it's risk appetite or it's investment time frame in terms of, where you are at your life in terms of, saving or investing or retiring, to me, the biggest grey space for this, and I'll give you the listeners out there, 2 words to run a mile. If you do hear them mention structured notes, if they do mention the word structured notes, run. And the reason what a structured note is, essentially they're offering you a return, but the framework that those returns are generated on are very narrow. You virtually need to have Earth, the Moon, Mars, Saturn, Jupiter all line up at the same time to hit that number that they're advertising. Yeah. Because there's always 2 or 3 different numbers. It's like if this happens, you'll get this, and I'll sell it based on that number. But if this doesn't happen, then this is what you get. And taking on that risk, which structured notes, unless you're a professional investor, no one should be in. We look at these things ourselves, and we've been in the game for 1,000 years. Now, even we find it difficult to really pull these apart. So to me, that's primarily what gets sold through a lot of the banks. And they've got an investment banking division on the other side who's raising the cash, and they build up a very complex options and derivatives package. And that's how they make their money, pure and simple.
Yeah. Yeah, it's well, I mean, a lot of that is how they make the money, but the upfront commissions that they get on those structured notes, and then the tail end for just churning is always a bit concerning as well. You really wonder how you make money out of it.
Well, I mean, let me go back to Graham's question about, he's mentioned a couple of banks in Singapore. So Singapore doesn't charge capital gains tax. Australia doesn't charge capital gains tax. Why would you put yourself through it? Why don't invest in Australia? Reduce your exposure to currency risk, because then it's an AED denominated. Doesn't mean you're invested in AED, but purely a worldwide diversification approach is required. But if you're you're going into a very niche product, relying on the Sing dollar to stay strong, there's a lot of things that can fall over that make that whole investment premise invalid.
Yeah, that's very true. It's and again, that's my concern, trying to open up an account in a foreign country which maybe you don't actually reside in, getting locked up in these investments, transferring a large amount of capital, and then going, shit, how do I get this money back now? I've got to convert it to a currency that, where depending on where I'm living in. I think Graham's in Thailand. And obviously just from Graham's point of view, he's trying to go through the process of, the search for yields, income yield that might support his retirement. But I really would query just the framework that these types of investments exist in. And there's a good reason why the yields are on offer so high. It's because they carry the same amount of risk.
I think also too, and I think this is that sort of mic drop moment. You got to ask yourself, why are these being only offered in Middle East and Asia? Not in Australia,
Yeah.
not in the United States, not in the United Kingdom, not in Europe. The reason being is because it is grey. It's not as solid as the bank representative will make it out to be.
Yep. Agreed. Absolutely.
So
So yeah, caution, beware.
it is, mate. So I think we'll leave it there. That's a good episode. I think we don't want to bore our listeners too much with us prattling on. There's lots of good podcasts out there to listen to, but please don't forget to subscribe. Give us a review. We haven't had a review for a while. So just give us 5. Give us 5 reviews out there. Don't ask him for much. It takes 20 seconds to give us 5 stars and a bit of a commentary.
Yep.
We're not vain, but we do love to feel the love. We do like to think there's people out there listening apart from our parents, and just give us a nod by just giving us a review. So, mate, let's leave it there, and let's get on with our day.
Sounds good, mate. Have a lovely day. Speak
You
soon.
too, mate. Thanks, mate.
Cheers, mate.